You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
Welcome to the wild world of private equity, the only business that's made more billionaires than oil, tech, and, I assume, those YouTubers who unbox toys for a living. You've probably heard private equity blamed for everything from the death of Toys R Us to your inability to afford a house. Honestly, some folks act like PE firms are hiding under your bed, waiting to steal your Beanie Babies and raise your rent. But what do these mysterious PE people actually do? Are they financial geniuses, ruthless asset strippers, or just over-caffeinated MBAs in Patagonia vests? Let's break it down today, using two technical terms you'll want in your back pocket. Liquidity think cash that actually moves, not just sits there looking pretty in portfolio company that's business speak for the place we're about to turn upside down. Strap in because you're about to learn how these titans operate, and maybe, just maybe, why your favorite childhood store is now a Spirit Halloween. Alright, time for a little myth busting. Private equity isn't a secret society unless you count conference rooms with too much mahogany. At its core, private equity is just any investment company that buys assets you can't trade on Robinhood. Think of it as Shark Tank, except nobody's pitching dog sunglasses and the deals run into the billions. The technical lingo here? Alternative assets, that's just stuff like airports, carbon credits, or even your grandma's favorite toll road. And fund of funds, which is basically a financial turducken, a fund that invests in other funds. Now, you might be thinking, wait, does that mean my gym membership could be a PE asset? Well, if your gym was profitable, you might be next on their list. The point is, if something is worth money, there's a private equity firm somewhere plotting to turn it into more money with spreadsheets and probably a few too many acronyms. So next time you hear someone complain about shadowy PE overlords, remember they're just really ambitious middlemen with better than average access to catered lunches. Let's take a quick detour into the world of venture capital, which is just private equity with a hoodie and an unhealthy addiction to kombucha. Venture capitalists or VCs, if you want to sound cool at dinner, parties specialize in investing in startups. That's our first technical term, startup, meaning a company that's more likely to have a foosball table than a revenue stream. And then there's liquidity event, which is not a pool party, but the moment a VC finally gets to cash out, usually via an IPO or a big acquisition. You might be wondering, didn't these guys just invent an app for cat yoga? Yes, and now they're on their way to a 100 million valuation on paper, at least. So while private equity as a whole is about buying everything from toll roads to toy stores, VCs are the risk takers who bet on the next big thing, hoping it's not just another crypto dog coin. Here's where the real drama starts. Buyout funds. This is the flavor of private equity that gets the headlines and the angry tweets. A buyout just means buying a whole company, usually with a lot of borrowed money, a process called leverage. Imagine buying a pizza with your friend's credit card, then eating it all yourself. That's leverage, PE style. Now, why do buyout funds have such a mixed reputation? Well, some see them as saviors who make struggling businesses lean and mean. Others think they're the financial equivalent of a raccoon in your garbage making a mess and leaving with the good stuff. But here's the setup. If you run a successful buyout fund, you'll make so much money, your only problem will be finding enough places to park your yachts. So if you're dreaming of running a buyout fund, keep listening. Just remember, with great power comes great responsibility and a lot of SEC paperwork. Step 1 to PE greatness. Get your structure right. Not your posture, though sitting up straight can't hurt, but your legal and financial setup. The technical jargon here, Delaware Limited Partnership. It's like the Swiss Army knife of corporate structures, flexible, sharp, and somehow always ends up in a lawyer's pocket. Then there's the Limited Partner Agreement, or LPA, which is the relationship rulebook. It spells out who gets what, who does what, and, most importantly, who can yell at whom when things go wrong. Let me tell you a story. In the movie The Big Short, Christian Bale's character locks in his investors with ironclad fund rules. No takebacks. Without that, everyone would have bailed and nobody would have cashed in. The LPA is your safety net and your investors too. So remember, if your structure is too loose, nobody invests. Too tight, and you'll need to hire a therapist for all the angry phone calls. Find the Goldilocks zone, people. Now, as a PE boss, you're technically running two companies, the fund itself and the management company. It's like being Batman and Bruce Wayne, lots of costume changes, but way more spreadsheets. The management company is packed with Harvard MBAs who earn more than most small countries' GDP. And here's the technical bit. They do due diligence, which means combing through financials like Sherlock Holmes with a calculator. You might ask, why pay them so much? Because if they mess up and buy a lemon, you're the one stuck making lemonade out of job losses and angry investors. This is also where you, the general partner, get to play CEO, chairman, and resident coffee snob. The management company keeps the wheels turning, the deals coming, and the analysts caffeinated. Bottom line, without this nerd army, your PE fund is just a fancy PowerPoint with no one to run the numbers, and nobody gets rich off a PowerPoint except maybe consultants. All right, step 2. Time to go hat in hand and ask people for money, but make it sound classy. Capital raise is the technical term basically, convincing rich folks to trust you with their fortunes. Here's another bit of jargon. Skin in the game. You have to invest your own money to show you're not just betting with someone else's chips. It's like eating at your own restaurant. If the food's bad, you suffer too. Now, you may be wondering, why would anyone give me their money? Well, you've got to promise them two things, higher returns and lower tax bills. Oh, and don't forget the 2 and 20 fee structure, 2% annual management fee, 20% of the profits above a certain hurdle rate. It's like a bouncer who takes a cover charge and a cut of the bar tab. If you don't have a billionaire uncle, start with your own cash and industry connections. Prove you can make money, and soon you'll be turning investors away like an exclusive club nobody really wants to join, but everyone pretends they do. Remember, the best way to attract investors is to make money, preferably lots, preferably their money. Now comes the fun part, shopping for companies. But instead of Black Friday deals, you're looking for acquisition targets with solid cash flow. That's technical speak for a business that won't run out of money before the next season of Succession. Your army of analysts and investment bankers will comb through the market, hunting for hidden gems or at least companies that aren't on fire. The goal, find a stable business in your specialty. If you know hotels, stick to hotels. Don't go buying pharmaceutical firms unless you're ready to explain what a monoclonal antibody is at Thanksgiving. Once you spot a target, you draft an indication of interest. That's PE lingo for, we'd like to buy your company, please. And here's a number that looks big but is actually cunningly negotiated. You're probably thinking, wait, why not just buy with cash? Because the magic word is leverage borrowing to buy big so you can own more with less. It's like using coupons at the world's fanciest store. Choose wisely because your investors expect returns, not sob stories about why you bought the blockbuster video of 2024. Time to flex that leverage muscle. In a leverage buyout, LBO for those in the know, you buy a company mostly with borrowed money. Think of it as buying a mansion with a tiny down payment, then renting out the rooms to pay the mortgage. Banks love it because the business itself serves as collateral. If things go bad, you're out, but the bank gets the key sand, your fancy office plant. Of course, this is where the drama happens. If you load up too much debt, the company can buckle under the pressure. If you get it right, you could turn a $10 million investment into $100 million in returns. If you get it wrong, well, congratulations, you've invented the world's fastest bankruptcy. Here's a technical term, capital structure. That's the mix of debt and equity, fancy words for borrowed money and actual investment. The trick is to balance the risk so you don't end up starring in a financial horror movie. So, if you ever wondered why so many PE deals look like extreme couponing for billionaires, now you know it's all about the leverage, baby. Now the real fun starts. Time to work your makeover magic on your new portfolio companies. That's PE speak for the things we just bought and hope don't explode. The playbook? Cut costs, merge operations, fire up those synergy engines. Synergy, by the way, is just a fancy word for let's hope two companies together don't fight like cats and dogs. Sometimes you swap out the CEO for someone who actually returns your emails. Other times you just pay down debt and wait for the value to rise. It's a bit like house flipping, but with more spreadsheets and fewer sledgehammers. Of course, critics say PE firms gut companies and lay off workers, and, well, sometimes that's true. But hey, you're just trying to create value. Or at least, that's what you'll say at your next family reunion when Uncle Bob asks how you sleep at night. So whether you're merging, cutting, or just waiting, the goal is the same. Make your portfolio company worth more than you paid. preferably a lot more. You've survived the spreadsheets. Now, it's time for the grand finale, the exit. No, not the fire drill. This is how you actually turn your work into cash. Your options? Sell to another PE firm because why not pass the hot potato? Or go public with an IPO, which is like putting your company on the world's fanciest eBay. Or sell to a strategic buyer, usually a bigger company with even more money and even less patience. Here's the technical twist: carried interest. That's the special sauce letting you pay taxes at the capital gains rate, not income rates, because nothing says American dream like a tax loophole. You might be asking, is it really that easy? Of course not. The market can turn, buyers can vanish, and sometimes you end up holding the bag. But when it works, you're riding off into the sunset on a golden Segway. So next time you see a headline about another billionaire minted by private equity, just remember, behind every fortune is a whole lot of leverage and probably a couple of really stressed out analysts.